Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this morning, and as always, send your questions to Brian Rezny at ReznyWealth.com. And make sure you visit our website, ReznyWealth.com. You can download any of our groundbreaking reports. In fact, the #1 downloaded report this year, 3 major risks you must avoid if you care about your retirement and your financial security. Go to ReznyWealth.com. That's ReznyWealth.com. Download that instant report. Learn the major mistakes you need to avoid as we go into next year. I think so many investors today unfortunately get taken advantage of by so-called advisors, Wall Street firms, banks, these annuity salespeople. But let's talk about 5 major topics today that you really need to really take a look at, and you really need to address for yourself to make sure you're not being taken advantage of. One of the big scams is cryptocurrency. You've heard about Bitcoin, cryptocurrency. You may have heard about Sam the scammer from FTX, the person that basically $8 billion is gone from client accounts now. That's crypto, folks. Crypto is a scam. It's a Ponzi scheme. I've talked about this for years. You should never invest in speculation investments because speculation investments go to zero. I think cryptocurrency is a big scam. I think there's a lot of people that got kind of suckered into it. And unfortunately, too many of you investors are going to lose your life savings or a big portion of it by investing in things like Bitcoin or cryptocurrencies. So remember, when it sounds too good to be true, it's clearly too good to be true. I talked a little bit about speculation investing. Remember this, speculating, buying investments that really you think are going to go to the moon and make you rich overnight, that's a speculation. Buy quality investments, make yourself wealthy, slow over time. That's really how the wealthy become rich. They basically make very educated investment bets. They do a lot of research. And over a long period of time, you become wealthy. If you think your net worth is instantly going to go up straight up and you're going to be a millionaire overnight, it's not going to happen. If you invest in things that are speculation, your net worth is going to go down and you're going to become broke. Let's talk about market, and is the market really ready to take off? This has been a question I have had from a lot of investors. Really, as we've gone through, 2022, we're going into 2023, and investors are like, "Wow, 2022 is not a great year, but is 2023 going to be better?" So this is the bottom line. You can't short time the market. And what does that mean to us? When we look at our portfolios, when we manage money, we're looking at not only the economy, but the investment markets every day, and we're doing a whole bunch of research every single day. But we're looking at the next 3 years. So while I don't know what's going to happen the next month or 3 months, if I look at the next 3 years, I like what I see. I think there's great opportunity. There's some great valuations, especially within the U.S. marketplace. I would continue to avoid the international marketplace at all costs and a lot of the emerging market economies. Just too much risk, not the return potential that I think the U.S. is going to pave the way as we get into 2023. So remember, the markets could be ready to take off. It could happen today. It might take 6 months. But again, you're not worried about what happens in the next 1 to 6 months. You're worried about what's going to happen in the next 3+ years. That's ultimately how you create financial security, whether you're retired or whether you're just starting out. What about that big inflation fear that everybody's had? One of the things you have to realize is this. It's year-over-year inflation that's going to matter. Now, while inflation ran about 8% plus in 2022, as you go into 2023, we don't see the next year another 8%. So it's that year over year. What we do see as we go into 2023 is really much more subdued inflation. The economy is clearly slowing down. The job market is definitely getting a little weaker. Investors and consumers are clearly somewhat tapped out, especially the ones that really got a lot of stimulus money and overspent on goods and services during the COVID period. So what do I see? I see less demand, more supply, which should bring down prices, which should really curb the inflation problem that we've had with here, not only in the U.S., but around the world. So inflation is starting to abate. I think we have a potential, depending what the Federal Reserve does, is even interest rates, as they increase them slowly, we have a potential if they raise them too much or too fast, which I think they're pretty conscious of now. I think ultimately there could be disinflation, which would not be good at all. Let's talk about annuities. And you know, one of the things I've talked about annuities for years, I hate annuities, and I fully believe annuities are complete crap. Kind of like cryptocurrency. While annuities are not a Ponzi scheme or a scam, they're really crappy investments. Unfortunately, a lot of you investors get suckered into these annuities. You go to the free steak dinner, you talk to the guy who calls himself an advisor who's no more than a salesperson of insurance products and annuities, and they're going to basically almost blatantly lie, skew the real facts about annuities in order for you to buy. Now let's recap on annuities. Annuities have high expenses that rob your return. Annuities, basically, you'll pay higher taxes when you take the money out, which again, robs your return. Annuities have bad lockup and surrender periods to get all of your money out, which again, hinders your return and hurt your financial security. Annuities are going to make low returns, if no returns, especially these equity index annuities that are often touted with free money bonuses and stock market returns. It's not going to happen, folks. Unfortunately, the average person that buys an annuity, it takes you about 3 to 4 years until you realize you were duped by the annuity charlatan. And then what ends up happening, you'll call our firm, Rezny Wealth Management, and we'll try to help you. But again, if you're sold an annuity with a 12-year surrender penalty at 12%, you got a long time to wait to get all your money out, because again, those surrender penalties are going to hurt, they're going to sting, and it's going to hurt your financial security. Remember, you can build a portfolio based upon goals and objectives. There's no free lunch with annuities. It's only going to rob your breakfast, lunch, and dinner. Unfortunately, it's going to take you 3 to 4 years till you figure that out. Let's go to Theo in Miami Springs, Florida. Big fan of yours since 2012. What effect does the FTX collapse have on the equity market? Theo, great question. FTX, folks, for those of you who don't know, was I call him Sam the Scammer, who basically started this exchange. Now there's $8 or $9 billion of customer money gone and vanished. So again, is that a scammer? Sure is. All cryptocurrencies, in my personal opinion, are a scam and a Ponzi scheme, so stay away. But is FTX collapse going to have a problem with the overall equity market? I would say no. You would have already seen that if there was going to be. The crypto overall scam market, I'm going to call it, is relatively small to the world economy and the investment markets. So what I would say is this: if you're one of the unfortunate people that got involved in FTX, I feel sorry for you. It's a learning experience. The best and cheapest way to learn, though, is from others' mistakes. Don't get involved in speculation investments like cryptocurrency. You're not going to get rich quick. You're going to get poor real quick when these things collapse and you realize what you thought you had was nothing than smoke and mirrors, and ultimately the money is all gone. Never speculate with your money. Never buy things you fully don't understand. Anything that sounds too good to be true is too good to be true. Stay away from those investments, because ultimately you'll be a better investor for the long term by methodically managing your portfolio or hiring a real firm to do so, and build your net worth slowly, so you'll have that really financial security that every person dreams of, but unfortunately very few people attain. Michael, I own 200 or 20,000 shares of BCH. They try to spin off a BLCO. As an investor of Bausch, when will the company transfer stock to BLCO? I'm very confused. So basically what you're talking really about, Michael, is Bausch stock, and I guess the question ultimately is you own a lot of shares of this. My ultimate question for you, though, is why do you own so many shares? When did you buy these? As a rule of thumb, and I don't care how good a stock you think it is or how good a company you think it is, or you work for the company, it doesn't matter. Never invest more than 5% of your net worth in any one individual stock, no matter what company it is. Because ultimately, every company can have bouts of really bad returns, or even go out of business and bankrupt. I remember stories of people that would call me and talk about Sears and, oh, should I buy a lot of Sears stock? Sears today is bankrupt and gone. By the way, it used to be the wealthiest company in the world 40 years ago. Not anymore. And the landscape is littered with great companies at one time that, again, are no longer here. So make sure you do your homework. Never overload the boat on any one individual stock. I'm going to take a quick break. I'll be back with your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. I hope you're enjoying today's program, and as always, go to ReznyWealth.com. That's ReznyWealth.com. And if you want to send me a question for today's program, send it to Brian Rezny at ReznyWealth.com. I know we're getting a lot of calls and a lot of emails that come in for our various shows. As always, when you're at ReznyWealth.com, make sure you download any of our free groundbreaking reports. The big report that it seems for at least the last 12 months, the 3 biggest risks you must avoid now. It's free on my website. Go there, download it, educate yourself. Obviously, we're going into a new year. Investors are concerned maybe about your net worth. Maybe you had a bad year last year and you're realizing, should you be doing things different? There's a good likelihood you should do things different. One of the big mistakes that investors often make that we find after managing money for over 30 years and helping literally thousands of investors is investors often will procrastinate and take their time to make a change from the current firm they're utilizing that maybe is not doing the right job, not up to par, and not a feeling fiduciary money manager. Cliff, I'm retired over age 72 and obviously must withdraw my RMD from my IRA. It is a substantial amount. Can I deposit some of my RMD money into a Roth account? Thanks for a great show. Cliff, no, you can't. So you're over 72, you're currently not working, you don't have earned income. You cannot take money from an RMD and put that into a Roth account. That's a prohibited transaction. You don't have earned income at this point. What you could do is obviously take the money out overall, from your RMD or your IRA that you're required to every single year. And by the way, that amount as you get older will technically go up because the divider goes down. Invest that into clearly a taxable account. You could move it over to that, and then obviously have that professionally managed and make sure you're doing the right thing with all of your money. What we typically find with our clientele is about half our clients actually don't need that required minimum distribution, that RMD, yearly. So what do? It goes out of the IRA account. They pay tax on it, unfortunately, and then it goes into their taxable account, and then you continue to grow that portfolio for future needs and income needs with that money. So again, that's one of your options. Phil in Bonita Springs, Florida. What do you think about IBM and Microsoft? Phil, great question. I'm not a fan of IBM at all. I do like Microsoft. It's come down about 30% or so year to date. I like the stock. The valuation's getting at a reasonable level, still kind of overvalued, but I like Microsoft, the metrics, the diversified portfolio, the future growth. Sometimes you're buying stocks that are slightly overvalued, but you're looking at these things for the next 3 years. I like Microsoft for that respect, but as I've talked earlier in my show, never buy more than 5% of any one individual stock. And for most people, if you're going to be properly diversified, you want to own about 3% of some stocks. Make sure you sprinkle that with a good helping of ETFs, exchange traded funds. You have to be properly diversified. One of the things I find, Phil, also is investors will often buy a basket of 30 or 40 individual stocks, and that's it. It's not enough diversification. What you'll find with a portfolio like that is you'll get whipsawed all over. You'll make lesser return than the base index you track, and you'll have actually lesser return. So more volatility, lesser return, not a good combination. So really temper how you build individual stocks in a portfolio because it might not be your best option. Bonnie in Elva, Florida. What do you think about the Treasury bills right now? Actually, a great opportunity. Treasury bills are short-term paper, less than a year. You could buy them at different increments, but they're less than 12 months long. And a lot of your Treasury bills today, because interest rates are up, again, I think this is temporary, are paying well over 3+%. So again, are they an opportunity for short-term liquid money that you want to have safer? Definitely. So there's an option there. But again, when rates basically eventually come back down, which we are fully expecting over the upcoming years, again, T-bills are not going to pay the rates they currently pay. If you look at historical rates on T-bills the last 4 or 5 years, they basically have almost paid nothing, and certainly less than nothing after inflation. So your key to making money on your portfolio is having a return higher than the inflation rate, because that's actually real return above inflation. So if you're making 3% on your money and inflation's running 5%, you got a -2 real rate of return. If your portfolio's making 5% and inflation's only 3%, well, of course, now you got a positive 2% return. The key is, what's the inflation factor? What's the interest rate or the return on your money? And what's the net positive effect? That's ultimately where you want to go. I've got an anonymous from Florida. We own an annuity, Great American, which is now Mass Mutual. 5-year term, we are 3 years in. Is it wise for us to withdraw with our penalty-free money and invest in a Roth IRA? Well, first off, can you do a Roth IRA? Are you eligible? That's number one. Does it make sense to take the money out of the annuity? So the key is, every year, most annuities give you a 10% penalty-free withdrawal. That's it. So while you're in this 5-year annuity and you're 3 years in, realistically, most of them will only allow you to take a 10% penalty free. Do you take the money out? What I would say is this: annuities in general have high expenses and low returns, and of course, surrender penalties, as you're realizing. I'm not a fan of annuities, period. I would never have you buy an annuity, and I suggest every person that owns an annuity seriously needs to look at the annuities they own, what you're really making on this annuity, what's the internal cost structure of that annuity, and are you better off taking some of that penalty-free money out, or maybe all of it out at penalty, depending on your situation, and investing in a different investment type that is better suited to really meet your long-term goals. Annuities are often sold to investors, and they're complicated, that don't understand what they're buying, but usually get sold on false benefits that never come true. So taking some money out penalty-free might make a lot of sense for you and your money long term. And I think too many investors don't look at that option. But that is an ultimately great question. I'm going to take a quick break. Make sure you go to ReznyWealth.com. Download any of our groundbreaking reports. Again, one of our #1 download report, 3 biggest risks you must avoid now. Go to ReznyWealth.com to download that report. And as always, if you're concerned about your wealth, if you're concerned about maybe the way your money is being managed or mismanaged, and you want a real money management firm that is a fee-only fiduciary money manager to help you out, call Rezny Wealth Management during the week, or visit our website, ReznyWealth.com, and click on that consultation tab. I'll be right back with more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not fee-only fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. And we're back, and I hope you're enjoying today's program. And as always, send your questions to Brian Rezny at ReznyWealth.com. And do visit our website, ReznyWealth.com, for not only times availability of my TV shows, but also my live radio show on Sunday mornings. You know, we get a lot of questions all the time for both my TV and radio show, and we really enjoy the questions. We enjoy helping our listeners make better financial decisions around their money. One of the things I want to stress, and I get this question a lot, is how do I find a real financial advisor or a real money manager? And ultimately, the firm that you should entrust your money to needs to be a fee-only firm, a fee-only fiduciary firm, and they need to be a money management firm. And when you do find a firm like that, and again, one of the great tools that we have on our website at reznywealth.com is our interview questionnaire if you're going to interview a firm to manage your wealth. Real advisor, fake advisors, the report. It's free. It's instant download on our website at reznywealth.com. Check it out. Learn, educate yourself so you can protect your money from bad financial advice. Steve in Bokeelia, Florida. What do you think about Google? I actually like Google. It's come down a lot. Valuations are actually reasonable. They're really the 800-pound gorilla when it comes to search. I think long-term, I think Google has great opportunity. I don't think you're going to see the kind of returns coming out of Google in your portfolio that you saw maybe the last decade or so, simply because the bigger they get, the slower they can grow. But I do like the growth aspects. I do like the strategy that they have. And I think ultimately it's part of a portfolio. But again, do your own research. I think it's a great opportunity. Jesse in Cape Coral, Florida. My advisor is recommending 2 REITs, real estate investment trusts, folks. I really don't understand them, and they seem like they are not liquid. First off, Jesse, a REIT is a real estate investment trust. It's basically kind of like a cup that basically buys different types of real estate. So what your advisor is trying to sell you, it sounds like, is a non-traded REIT. So yes, these are not liquid. And when you buy a non-traded REIT from, it's really a broker, not an advisor, these are products he or she is required to sell. So it's not liquid. Your money can be locked up for 8 or 10 years or longer without any liquidity. If that investment goes south and you want to get out, you can't because it's not liquid. So why do brokerage firms or so-called advisors sell non-traded REITs? Because they make about 8 to 9% commission on average when they sell these. You then put your money in a product that takes about 18% off the top between commissions and underwriting fees. So let's say you invested $100,000 in non-traded REITs. Only about 80 cents on the dollar of your 100 is actually going to get invested. The other about 20% is going to go to commissions and fees to that non-traded REIT subsidiary that's basically built in this product. That is crazy. So how would you like to lose 20% from day one? Well, you shouldn't. By the way, there are traded REITs. Traded REITs means you can buy them and sell them like a stock that could own similar real estate as a non-traded REIT. So why doesn't your advisor, so-called advisor, your broker salesperson, show you a traded REIT? Because they don't make big commissions on traded REITs. And traded REITs, by the way, are liquid. So let's say you did a lot of research, you bought a traded REIT, and then 3 years later, the industry is changing or the type of real estate in that portfolio is not wanted anymore and it's starting to go down. You could then instantly sell that traded REIT where you could not on a non-traded REIT. So remember that. Big, big difference. At the end of the day, understand what you're getting yourself into. Because if you don't do proper research, you're going to get into something that you don't want to get into or realize you didn't want to get into when it's too late to get out. Fred in Naples, Florida. I own shares of Altria. I like the dividend, but the overall investment has been bad. Your thoughts, should I sell? I'm not a fan of Altria, and it's basically the old Philip Morris company. They changed the name, which a lot of companies do to get rid of the stigma from smoking. So I'm not a fan overall. Whenever you buy any investment, whether it's a stock or any investment at all, you're looking at what's called total return. Total return is the growth or the decrease in value of your share price, and the dividend. That's total return. So if Altria is, I'm just going to use a number, is paying 6% dividend, but the share price is going down 4 or 5% a year for the last decade, what's your real return? It's pretty much flat or negative. So you got to look at that. A lot of people will often want to buy investments that pay substantial dividends because it looks really good, but they don't look under the hood. And all of a sudden you pull the hood open and there's no engine. So Altria is kind of one of those things where you're not going to see the growth in share price. The dividend looks good, but total return stinks. I think there's better places to put your money. You are often better buying lower dividend paying stocks that have growth potential of earnings because that really can give you the best opportunity overall. Bob from Cape Coral, Florida has got a question about variable annuities. I was sold a few different variable annuities over the years by my so-called advisor, as you call them. The problem I have with the variable annuities is they're highly volatile. Our return is never as good as what we thought it was going to be, even though the market goes up. I talked to our person a few different times, and he assures me things will come back. Help, need your opinion. Bob, you've got a great question there. First off, variable annuities are kind of like a stock, bond, or a mutual fund with an extra wrapper. So think about it this way. Your broker advisor sells a variable annuity because, again, they pay huge commissions and they have big surrender penalties to get all your money out if you wanted to. Because the expense ratio on variable annuities is so high, the typical variable annuity, Bob, that we have reviewed at our office is about 4 to 4.5% every year. So think about that. What you're seeing is you're not seeing the returns you thought because your expenses are so high. So imagine the stock market, just to look at simple numbers and simple math. If the market goes up 10%, well, you made 10% on your money with your stock portfolio. Inside a variable annuity, if that variable annuity made 10% as an example, but your expenses are 4.5% for the year, every year, you made 5.5%. So you made about half what the market made. Think about this. Half what the market made with the same volatility. Wait, it gets worse. Any money you do make when you do take it out is taxed at ordinary income rates. So you might be paying double the taxation, which is bad. Okay. Now, the next big hitter is this. Markets always go through volatility. So imagine you have $100,000 in a variable annuity. Okay, the market goes down 20%. Well, your variable annuity is going to go down at least 20% or more because the expense ratio is so high. So you have actually less money to come back. So it compounds the problem. The longer you own the variable annuity, the worse it's going to be for your overall portfolio. What I would suggest you do, call our firm, schedule a consultation. We do manage larger portfolios. Schedule a consultation. It's unfortunate that too many of you investors out there get tied in with one of these Wall Street firms or banks or these annuity people that sell product. They don't manage your money. You get god-awful service. You get god-awful money management, and it really hinders your financial security. I thank everybody for all those questions. If you're tired of bad advice, poor client communications, and just feeling like your advisor is not up to the job, call Rezny Wealth Management for real money management and real advice. The comment I often get from people that call and schedule with my firm, we should have called years ago. So as I've always discussed, don't procrastinate. If you realize your portfolio is not doing as well as it should, if you're realizing your advisor is really not an advisor at all, and you want a real feeling fiduciary money manager who's going to look out for you and your family and take good care of you, call Rezny Wealth Management. Make sure you do visit our website at reznywealth.com. And as always, have yourself a safe and profitable day.